Welcome to the NAPAICC Insider Podcast. I'm Scott Harris, licensed public adjuster and CEO of NAPAICC Inc. In today's episode, we're breaking down 5 hidden insurance traps buried inside modern property insurance policies, and why homeowners need to understand these issues before a hurricane, plumbing loss, fire, or major claim ever occurs. Because one of the biggest misconceptions in property insurance is this: people think lower premiums automatically mean better value. But in many cases, lower premiums are being created by quietly removing protections, limiting coverage, increasing deductibles, depreciating payouts, or shifting more financial risk back onto the homeowner. And most policyholders do not discover these hidden traps until they are already standing inside a damaged house, trying to figure out how to rebuild their lives. Today, we're going to break down the $10,000 water damage trap, roof depreciation traps, hidden deductible issues, matching limitations, and one of the biggest misconceptions in homeownership, the mortgage insurance illusion. Because the most dangerous words in modern property insurance may no longer be claim denied. They may actually be discount applied. Please like, subscribe, and share so we can keep reaching people who need to understand what's really happening. Your support truly helps. Florida homeowners are being crushed by insurance premiums. Everybody knows it. But what many homeowners still do not realize is this: the lower premium often comes with hidden trade-offs buried deep inside the insurance policy. And those trade-offs can financially devastate a family after a major claim. Today, we are breaking down some of the biggest hidden insurance traps quietly spreading through modern property insurance policies, and why understanding your coverage before disaster strikes matters more than most people realize. Let's start with what may be one of the most dangerous trends in property insurance right now: the $10,000 water damage trap. Many homeowners believe they have water damage coverage because the policy technically says they do. But then a pipe bursts. The mitigation company arrives. Dry out begins. Containment goes up. Demolition starts. Equipment gets placed throughout the home. And suddenly, the homeowner discovers something terrifying. The emergency mitigation alone may consume most of the available coverage limit before reconstruction even begins. Now the kitchen still needs to be rebuilt. The flooring still needs replacement. The cabinets still need repairs. The walls still need reconstruction. But the insurance money may already be gone. Technically, the policy responded. Reality, the family is trapped inside a partially demolished house, trying to figure out how to fund the rebuild themselves. And unfortunately, many homeowners do not discover this trap until after the damage has already happened. But water damage limits are not the only hidden financial trap quietly spreading through the insurance market. Let's talk about the hidden roof trap inside many insurance policies. Most homeowners assume that if their roof is insured, the insurance company will fully pay to replace it after major storm damage. That assumption is becoming increasingly dangerous. Many policies now pay actual cash value, or ACV, on older roofs, which means depreciation gets applied. A roof that costs $30,000 to replace may suddenly produce a much smaller payout once the insurance company factors in age, wear, and depreciation. Meanwhile, the homeowner still faces full price reality: labor costs, materials, permits, tear-off, disposal, and code upgrades. The roof may technically be insured, but financially, the recovery may never be fully funded. And during hurricane season, that gap can financially cripple families already trying to recover from a catastrophe. Then there is another trap almost nobody pays attention to until after a claim gets filed: the hidden deductible trap. Many homeowners focus almost entirely on the monthly premium, while barely looking at the deductible structure inside the policy. But modern insurance policies are increasingly carrying $5,000 deductibles, $10,000 deductibles, and sometimes even higher all other perils deductibles. Now think about what that means in the real world. A kitchen leak happens, an appliance fails, a plumbing line bursts. The homeowner suddenly realizes the claim may barely exceed the deductible at all. So after paying premiums for years, the policy becomes practically unusable for many everyday losses. Technically, coverage exists. Reality, the homeowner absorbs most of the financial damage anyway. And even when the claim gets approved, another hidden trap often appears immediately afterward: matching limitations. A section of flooring gets damaged. Part of the kitchen is affected. One area of siding or roofing needs replacement. The insurance company agrees to repair the damaged area, but refuses to pay to match surrounding materials. Now the homeowner gets left with mismatched flooring, different cabinetry, patchwork paint, or roofing materials that visibly do not match the rest of the home. And in many older homes, the original materials may not even exist anymore. Technically, the damaged portion got repaired. Reality, the home never truly gets restored back to uniform condition. The carrier saves money. The homeowner lives in the patchwork. And finally, this brings us to one of the biggest misconceptions in homeownership today: the mortgage insurance illusion. Many people believe if my mortgage company approved the policy, the coverage must be good. That is simply not true. Mortgage lenders primarily care that the property itself is insured enough to protect the loan collateral. They are not evaluating whether the homeowner can realistically survive financially after a major disaster. So policies containing water damage sublimits, high deductibles, roof depreciation, actual cash value endorsements, and serious coverage restrictions can still fully satisfy mortgage requirements. Then disaster strikes, and the homeowner suddenly discovers the structure may technically be insured, but the financial recovery may still collapse. The bank protected the collateral, but nobody protected the homeowner from the financial consequences of inadequate coverage. And that is the bigger issue quietly developing throughout the insurance industry right now. The market did not magically become cheaper. Coverage became narrower. Risk shifted back onto the homeowner. And many families will not discover what disappeared from their policy until the worst day of the year finally arrives. The most dangerous words in modern property insurance may no longer be claim denied. They may actually be discount applied, because many homeowners are unknowingly trading away critical protections simply to keep their monthly premiums affordable. And by the time they realize what disappeared from the policy, the damage has already happened. If you find this content valuable, please help us get it in front of more people by liking, subscribing, and sharing. We genuinely appreciate your support. If this kind of content is useful to you, please like, subscribe, and share it so we can keep reaching people who need to understand what's really happening. Your support truly helps.